News Corp is having a good day today. It reported a couple of days ago now. Almost happened in the US.
Carrying on from yesterday, and it was good to
Yeah.
see that it actually held its gains overnight, because unfortunately there had been a bit of a pattern of giving back the gains in Australia when it traded again the next day in New York. But so News Corp's one that really stacks up well on a value basis. So it's really a sum of the parts story. So the main asset in there is the shareholding in REA. But if you strip that out, the current share price of the company only implies about $3 billion of value for all the other assets. And I mean, we think Dow Jones alone is worth about double that. Dow Jones had another cracking result. That's now 28 straight quarters of double-digit earnings growth in that business. And I know some viewers might sit there thinking, oh, Dow Jones, they're in the Wall Street Journal, isn't that a newspaper business? But the reality is it's largely a digital subscription business these days. They have a lot of professional information services as well. But even within Wall Street Journal, it's really a subscription business that is something more akin to a Netflix than an old school newspaper stand business.
And it's a data business as well.
That's absolutely right. They've got some great products. Their risk and compliance product has been growing 15 to 20% per annum for some time now. That's a $200 million business in its own right. And even across some of the rest of the portfolio, there are some really interesting assets in there. HarperCollins, the world's second largest book publisher, a lot of great IP within that business. And also the number 2 real estate platform in the US, Move, and particularly given some missteps by Zillow in the US, we think that's a business with a strong future. Now managed by Tracy Fellows, who did such a great job at REA.
Yeah. Okay. So 2 questions: REA result. Do you consider that, or how do you consider that when you're considering all of News Corp? And did you rate the result that came through yesterday?
Look, I did. REA is a fantastic business. I think it's one of the highest quality businesses on the ASX. And actually, one of the reasons we own News Corp is that, you can look at News Corp 2 ways. Either you're paying the market price for REA and you get everything else almost for free, or you ascribe some real value to assets like Dow Jones and HarperCollins, and then you get cheap entry to REA, which is a fantastic business. And I think the thing to keep in mind with REA and Domain, they both sold off really heavily when everyone started getting concerned about the property market. But it's important to remember that, as REA pointed out in their call yesterday, they sell listings, they don't sell houses. So falling house prices, as long as people are still getting married, getting divorced, having kids, having the kids move out, they're still going to move house, and they're still going to be listing properties on those platforms.
Do you mark News Corp down at all because it doesn't provide explicit guidance? Is that very important to you at Investors Mutual?
Look, I wouldn't say that not providing explicit guidance isn't necessarily a major concern. I think particularly for someone like News Corp that has so many different businesses that aren't always operating at the same speed. You might have some that are firing, some that aren't. I think as long as you're getting decent outlook commentary, and what I will say with News Corp is that the disclosure has improved a lot. I mean, it was only 2 or 3 years ago they weren't even splitting out Dow Jones. So the disclosure there really has improved out of sight. And there's always going to be a bit of an overhang when you have a controlling shareholder. But certainly the disclosure has improved.
Now, on to another company, or we'll run out of time. TPG Telecom, it has guided to an initial earnings impact to be negative from the deal that it's done from Telstra. But do you see that as a real positive going forward? Oh,
we think it's a phenomenal deal. Not just for, it's a win-win for Telstra and TPG. It's obviously a loss for Optus, which is why they're complaining about it so much. But what it really goes to show is that it's an industry that is now focusing on returns. You've had a massive kind of perfect storm for the telco sector over the last few years. You had a mobile price war, you had the NBN, which decimated margins in consumer broadband, and then you had the pandemic, which meant that mobile subscribers actually went backwards for the first time, I guess, since the old Nokia 6610s when we were all playing Snake. But now, going forward, TPG was the most heavily impacted by the closed borders because they do over-index with new Australians and with international students and the like, so they also gain the most when that opens up. And just to touch back on that deal with Telstra, this gives TPG a much better network footprint and really gives them room to grow outside of their traditional strong areas of Sydney Metro, and not just add subs in the regions where they're doing the spectrum and infrastructure sharing with Telstra, but also amongst Metro customers. It's all well and good if you're in the city and you've got great signal, but if you go on holiday and all of a sudden you've got 0 bars on your phone, it becomes a problem. You might look for another operator. So TPG is one we really like, and telco's just overall. You hear everyone talking about inflation, supply chain challenges. Well, telco's a sector where actually, number one, it's very defensive. It's recurring revenue. No one cuts their mobile phone contract or their home broadband, or it's just about the last thing you do. So in a downturn, it should be pretty recession-proof.
And you're confident about pricing power, yeah.
And there's pricing power. We've actually seen Telstra and Optus both raise mobile prices, and against a largely fixed cost base, we think the telcos are in really good shape. So, we're TPG shareholders. The large cap guys at IML have quite a lot of Telstra, and we really like the outlook for both businesses.
Okay, good. Now, ReadyTech Holdings, RDY is the ticker code. So this is sort of mining tech, right? Is that why you are attracted to it at Investors Mutual? Because in that mining sort of services space, it's a bit surprising.
So ReadyTech's actually education and local government software.
Oh, apologies.
That's okay. I love talking about ReadyTech. It's one of my favourite stories, actually.
Clearly I need to be informed.
I'll do my best to do that. So ReadyTech provides mission critical, born in the cloud software for education, employment, and local government. It's a business that's growing at a compound annual growth rate of 15 to 20% organically. So you're getting 20% organic growth on a PE of less than 20. So if I compare that to one of its competitors, Tech One, ReadyTech's on half the multiple with more than double the organic growth rate. It's still led by its founder, Mark Washburn, who's an excellent CEO. And it's a story that we really like. And again, similar with the telcos, this is real mission critical stuff for a really stable customer base, largely public sector. And just demand for these services is going up over time.
So when you guys are looking at tech, you're still looking to see a company that is getting and building recurring revenue, annual recurring revenue, slowing cash burn. I mean, is this a company that was in that, investing for growth at all cost phase, or has it always been, because it's founder led, perhaps a little bit different?
ReadyTech's interesting because it actually listed with 40% EBITDA margins. So It's always been profitable. The founder bootstrapped it from the beginning with his co-founder. Then Pemba Capital, a growth private equity firm, came in and provided some capital as well. So the business has always been run to make money, and it's interesting. I mean, it's a real mindset trying to make money. I mean, if I spend $1.20 for every dollar of revenue I collect, it shouldn't be that hard to grow revenue. But actually making that pivot, you're seeing some of these cash burning companies we think are really going to struggle to make that transition now that the capital markets are probably shut for some of these loss-making tech companies. So ReadyTech is it's got all the attributes for a fantastic business in any sector. Recurring revenue, great management, strong operating margins, great market position, and a really sticky customer base.